You now understand what an option is, how calls and puts work, how to think about strike price and expiry, and what determines the premium you pay. All of that knowledge lives in your head. The options chain is where it becomes real. The options chain is the live table that shows you every available contract on a given stock, every strike, every expiry, every price, in a single view. It is the instrument panel you will use for every trade you ever make. A lot of new traders open an options chain for the first time and immediately close it again. The columns look confusing. The numbers seem random. This video changes that. By the end, you will be able to open any options chain, find exactly the contract you want, and understand every number you see. Before we read the numbers, let us understand the structure. An options chain is organized around two dimensions. The first dimension is the strike price, the vertical axis. Strikes are listed in order from lowest at the top to highest at the bottom, or the reverse depending on the platform. The second dimension is the expiry date. You select this at the top of the chain, and the entire table updates to show contracts for that expiry. The chain itself is split into two halves. On the left, call options for each strike. On the right, put options for the same strikes. The strike prices run down the middle, shared by both sides. Every row is one strike. Every column is one data point. Once you understand this grid, the rest is just knowing what each column means. Let us walk through each column, starting from the most important. The strike column sits in the center. This is the price we covered in video 3. The bid column shows the highest price a buyer is currently willing to pay for that contract. The ask column shows the lowest price a seller is currently willing to accept. The last column shows the price of the most recent transaction. This can be stale if trading is quiet, so it is the least useful of the three price columns. Volume shows how many contracts have traded today. Open interest shows how many contracts are currently open across all participants, not just today, but total outstanding positions. These 6 columns, strike, bid, ask, last, volume, open interest, appear on every options platform in the world. Learn these 6, and you can read any chain anywhere. Here is what a real Apple options chain looks like, using Apple at $182.50, with 30 days to expiry. Starting from the call side, strike $175, bid $8.10, ask $8.30. In the money, Apple is $7.50 above this strike. Strike $180, bid $4.60, ask $4.80. Also in the money, strike $182.50, bid $3.10, ask $3.30. At the money, the strike closest to the current price. Strike $185, bid $1.90, ask $2.10. Out of the money, strike $190, bid 65 cents, ask 75 cents. Further out of the money, strike $195, bid 20 cents, ask 30 cents. Deep out of the money. Notice the pattern. The deeper in the money, the more expensive. The further out of the money, the cheaper. Exactly as video 3 explained. Now the put side of the same chain. Same stock, same expiry, mirror logic. Strike $175, bid 65 cents, ask 75 cents. Out of the money for a put, Apple is above this strike. Strike $180, bid $1.90, ask $2.10. Also out of the money for the put. Strike $182.50, bid $2.80, ask $3 even. At the money, strike $185, bid $4.20, ask $4.40. In the money for the put, the strike is above the stock price. Strike $190, bid $7.80, ask $8 even. Deep in the money. Notice something important. The $185 call costs about $2, and the $185 put costs about $4.30. Same strike, same expiry, different price, because the relationship to the current stock price is different for each side. In-the-money options cost more than out-of-the-money ones, regardless of whether they are calls or puts. The bid-ask spread is one of the most important concepts in options execution and one of the most overlooked by beginners. The bid is what buyers will pay. The ask is what sellers want. The spread between them is the cost of doing business. If a contract has a bid of $190 and an ask of $210, the spread is 20 cents per share, $2 per contract. When you buy, you pay the ask. When you sell, you receive the bid. The spread is not a fee you pay to a broker. It goes to the market maker providing liquidity. On liquid options with high volume, spreads are tight, 5 to 10 cents. On illiquid options with low volume, spreads can be 50 cents, $1, or more. Wide spreads eat into your profit. Always check the spread before entering a trade. As a rule, if the spread is more than 5% of the option's price, the option is too illiquid to trade efficiently. Volume and open interest tell you how liquid and actively used a given contract is. Volume is today's activity. How many contracts have changed hands since market open? High volume on a specific strike tells you there is strong interest in that contract today. It could be directional bets, hedges, or institutional positioning. Open interest is the cumulative total of all outstanding contracts that have not been closed or exercised. It builds over time. High open interest at a specific strike is significant. It suggests that a large number of participants have positioned around that level, which can act as a support or resistance reference for the underlying stock. As a new trader, you want both volume and open interest to be reasonably high. A minimum of 100 open interest per contract and a tight bid-ask spread are your two baseline filters for liquidity. Let us apply those filters to the Apple chain. Looking at the call side, 30 days to expiry. Strike 175, volume 245, open interest 1,823. Liquid. Strike 180, volume 892, open interest 3,241. Very liquid. Strike 182.50, volume 1,205, open interest 2,876. Highly active. This is the at-the-money strike, which always attracts the most trading. Strike 185, volume 1,876, open interest 4,523. The highest open interest in the chain. This is where the market has the most concentrated positioning. Strike 190. Volume 934, open interest 2,156. Liquid. Strike 195, volume 412, open interest 987. Thinner. Acceptable, but watch the spread. All of these are tradable. The concentration at 185 is worth noting. Selecting the expiry date is the first step before you read a chain. Most platforms show you a drop-down or tab at the top with all available expiries. Weekly, monthly, and sometimes quarterly. The dates are listed in order from nearest to furthest. Standard monthly options expire on the third Friday of every month. Weekly options expire every Friday. For the examples in this series, we use monthly expiries in the 30 to 45-day range. Enough time for a thesis to develop, enough liquidity to get in and out cleanly. As you go further out in time on the same strike, premiums increase, and open interest generally decreases. The most liquid expiry for any stock is always the nearest standard monthly. That is where volume concentrates. For your first trades, stick to the nearest monthly expiry that gives you at least 30 days. Here is how to use the chain to select your specific contract. You have done the work. Apple is at 182.50, you are bullish, and you want a call option expiring in 30 days. Step 1. Select the 30-day expiry from the drop-down. Step 2. Find the at-the-money strike, 182.50, as your reference point. Step 3. Decide on your strike. You want slightly out of the money, the 185 strike. Step 4. Check the bid-ask. Bid 190, ask 210. Spread is 20 cents, acceptable for a liquid name like Apple. Step 5. Check volume and open interest. 1,876 volume for 1,500 open interest. Very liquid. Step 6. Decide your entry price. You can pay the ask, $2.10, to fill immediately. Or you can place a limit order at the mid-price, $2 even, and wait for a fill. That is the full selection process. 6 steps every time. The mid-price is the most practical entry point for most trades. The mid-price is simply the midpoint between the bid and the ask. Bid 190, ask 210. Mid-price is $2. Placing a limit order at the mid gets you a better price than hitting the ask, and on liquid options like Apple, it fills quickly, often within seconds during market hours. On less liquid options with wider spreads, you may need to move your limit price closer to the ask to get filled. As a general rule, always use limit orders, never market orders, when trading options. A market order on an illiquid option can fill at the ask, or worse, at a price even beyond the ask if the market is moving fast. Limit orders protect you from paying more than you intend. Start at the mid-move toward the ask if you are not filling after 30 seconds. The options chain also tells you something about where the market is positioned and where it expects the stock to go. Large open interest concentrations at specific strikes act as magnetic levels for the underlying stock. If the 185 strike on Apple has 4,500 open interest on the call side, a large number of participants have bet on Apple crossing 185. This concentration can cause the stock to gravitate toward that level before expiry, particularly in the final week, as market makers manage their hedges. This is called options pinning, and while it is not a reliable enough concept to trade on directly, it is useful context when selecting a strike. If you are buying a call and the most concentrated open interest is at your strike, that concentration is working in your favor. Many others need the same thing to happen. One more tool in the chain, the implied volatility column. Most platforms show 4 per strike alongside the pricing columns. This tells you the implied volatility being priced into that specific contract. You will notice that 4 is not constant across all strikes. It forms what is called a volatility smile or skew. Out-of-the-money puts typically have higher implied volatility than at-the-money options because the market charges a premium for downside protection. This is normal and expected. What matters for you as a beginner is the at-the-money implied volatility. It gives you a quick read on whether options across the board are cheap or expensive right now. If the at-the-money 4 on Apple is 30% when it normally trades at 22%, options are unusually expensive, which is a reason to consider selling rather than buying. We cover this in the strategy videos. 3 common mistakes beginners make when reading an options chain. First, looking only at the last price column instead of the bid-ask. The last price can be hours old on a quiet contract. It tells you nothing useful about what you can actually buy or sell for right now. Always use the bid to sell and the ask to buy. Second, ignoring the spread. A contract that looks cheap at 30 cents might have a 20-cent spread, meaning 2/3 of your investment disappears immediately in transaction cost. Check spread first. Third, picking strikes with low open interest. Less than 100 open interest on a contract you want to hold for several weeks means you might struggle to exit at a fair price when the time comes. Liquidity matters at entry and at exit. These 3 checks take 10 seconds and prevent the most costly beginner mistakes. Here is what you now know. 1. An options chain shows every available contract for a stock, every strike, every expiry, with live pricing and liquidity data. 2. The chain is split into calls on the left and puts on the right, with shared strike prices down the middle. 3. The 6 essential columns are strike, bid, ask, last, volume, and open interest. 4. Always use the bid-ask rather than last price. Use limit orders at the mid-price. 5. Check volume and open interest before entering. Both should be reasonable. Minimum 100 open interest as a baseline filter. 6. The 6-step selection process. Expiry. Reference ATM strike. Choose your strike. Check the spread. Check liquidity. Set your limit order. That is video 5 complete. The next video introduces the Greeks, the 5 numbers that tell you exactly how your option will behave as the stock moves, as time passes, and as volatility changes.